So Vertiv Holdings creates liquid cooling solutions for companies that are building data centers that are optimized for AI. So it's in a strong growth category and the business has been growing nicely. I've had the stock rated as a buy for a long time now. I last covered the company on March 11th, 2025. And again, I reiterated my buy recommendation for the company at that point in time. I wanted to revisit the company now a couple of months later and evaluate the progress the business has made and look at the new higher valuation. The stock is up over 25% since March 11th. So the valuation has increased by a meaningful margin in the last couple of months alone. So I wanted to see the new higher valuation and see if this stock is still a buying opportunity or if it's too late now and the valuation is too expensive for Vertiv Holdings. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So you can see here my buy recommendation, and the last time I updated that recommendation on March 11th. So unlike other YouTubers, I actually keep track of my ratings and put down the date so that I can have accountability for the research. So you can see for yourself the results of the research, and I keep track of this over time as well. I'll come back to this and update the recommendation and let you know what I think it is now on May 23rd. Starting with looking at the company's revenue growth, you can see strong organic demand for its products. 8.4 billion in revenue over the most recent trailing 12 months, up from 3.5 billion in 2016. That's good for a compound annual growth rate 11.3%. But growth has accelerated since 2020, and growth is accelerating again in recent quarters. The liquid cooling solution is highly in demand for these data centers optimized for AI. The heat that these computing technologies generate as they compute and deliver and train on these large language models is excessive and they need to be cooled. There's a couple of different ways you can cool these. You can cool them with air, or you can cool them with liquid. And recently, it's more favored the liquid cooling solution. And VRT expects that as it continues to grow share of the overall cooling market, that it could rise to roughly 1/3 of that market size. It's nowhere near that percentage right now. Historically, it's been more of an air-cooled market instead of a liquid-cooled market. But companies that specialize in liquid cooling, like VRT, like Supermicro Computer, which is another company that I cover, they've been reporting soaring demand from their customers for their solutions. So this is the part of the industry you want to be in, the liquid cooling solutions part, because that's the part that's growing the fastest. So as its sales have grown, so have its returns on investor capital, up to 14.9% in the most recent trailing 12-month period. Volatile over the previous 5 years to be sure, but the trend line is going higher from 11.8% in 2020 to 14.9% in 2025. Similarly, its cash flow from operations have been volatile in recent years. Going back to 2016, its operating cash flow to sales ratio was around 9%, and that's increased. It's almost doubled to 17.7% in the most recent trailing 12-month period. So the fundamentals of the business are improving as it's growing its revenue. And I like to see that from a business, especially a business that is working with a lot of hardware and that's more capital intensive. The business model, I like the fact that in addition to installing the systems, the liquid cooling solutions that it helps enterprises with, it also provides the servicing and the maintenance of those systems. So that's a nice little recurring revenue stream that VRT captures as a part of its sale. So every customer that it wins, it likely wins that servicing and maintenance contract. Not 100% of the time. Sometimes companies will want to unbundle that from the sale of the hardware itself. But many times they'll capture that sale, and that part of its business, while it's still small, is growing very nicely. And if its revenue growth continues at this scale, then that part of its business will become more attractive to its customers that might want to consolidate with one company those two services. All right, so now let's look at valuation because I've liked the company's prospects for a long time. I've liked the industry it's operating inside. But let's look at valuation because the valuation has increased meaningfully since the last time I visited the company in March. It was trading at a forward PE of around 18 to 20, and now it's trading at a forward PE of around 27, which is about where it's traded at, right? There's been times when it's traded at a lower valuation over the previous year and a half or two, and there have been times where it's traded at a more expensive valuation over the previous year or two. So it's about in the middle of its trading range according to valuation, according to the forward price to earnings ratio over the previous 2 years. By the way, I'm getting all these charts from finchat.io. There's a link in the description for a discount if you use my link to sign up. All right, so now that I looked at valuation on a forward price to earnings basis, I also look at valuation using my proprietary discounted cash flow model to calculate a fair value of the stock. And my fair value calculation has this business worth $78 a share. The current market price is $104 a share. So, according to my DCF calculation, the stock looks overvalued. According to the forward price to earnings multiple, the stock looks fairly valued. And so, combining the two and making a estimate on valuation or giving a score on valuation, I would say the stock is overvalued or slightly overvalued according to valuation, right? But that's just one out of the six things I look at. It's not the only thing I look at when making a decision, valuation, right? Wrote an entire book about the six things I look at, and valuation is only one out of those six things. And Vertiv doesn't score terribly on this valuation metric. It's just overvalued, right? It's not terribly overvalued or grossly overvalued. It's just overvalued, right? So bringing it all together, all of the things I look at comprehensively, including valuation, I will say that the valuation, the overvaluation of the business is the is overwhelming the other factors of the business that are really strong. It scores relatively highly across many of its factors. The valuation, it scores poorly, and the risk factor is also elevated right now due to increasing tariffs. And just this morning, President Donald Trump suggested a 50% tariff on Europe. And so the markets were getting a little bit complacent about that tariff risk. And so, given all of that, I am going to downgrade Vertiv Holding stock to a hold market perform. And I'm updating that recommendation on May 23rd. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.